Hey, good morning, everyone. Marty Missouri here, April 20th, 2022, with a quick market technical snapshot for you. As usual, we'll take a look at the S&P 500, the 60-minute, the daily, the weekly, and the monthly chart. Let you know what I'm seeing and what I'm thinking, short and long term. And then just 30 seconds each on two positions that we just began scaling into this morning. And that's obviously a message to you clients out there. Anybody who stumbles upon this video that does not happen to be a client, I am not making recommendations to anybody here. These are just examples of what we're doing within client portfolios, and this is just to keep clients abreast of that activity. Okay, so your 60-minute chart, huge rally yesterday. Talked about that this morning on the blog. I shared with you yesterday's entry to our internal log and talked about the narrative around there. My thought was that, and I wondered this when I saw the headline early in the morning yesterday, International Monetary Fund is ratcheting down global economic expectations, or their global GDP forecast. I haven't read it yet. I like to read the IMF's commentary. I'm just going from the headlines. They mentioned the Russia-Ukraine conflict as being a big weight on the global economy. And we technically actually had a pretty good looking short-term picture anyway. So you have your falling wedge, which when you couple that with divergences in the MACD and the RSI, that are positive, so you have lower low and then a higher low here, that typically is a pretty reliable pattern if you're a really short-term trader. And sure enough, busted out of that with some force sitting here today. As I speak, the S&P is just flirting with the flat line, just a little bit above it. Last week was rough. In fact, April's been pretty rough, as you can see here. And yesterday on the written blog, I said that, these nice rips that we've been seeing on a short-term basis have all been faded. Yesterday's had good breadth, but it had weak volume. I guess my base case is that, the market has more to explore lower. But right now on the immediate chart, it still looks okay. On the 1-year daily chart, as you can see right here, folks, we continue to battle with that 50-day moving average. Broke above that big yesterday, losing it at the 200-day moving average today, and flirting with this right now resistance, or it could be support because we're slightly above that, at the 50% retracement line, and then this other line here, support or resistance line, depending on which side of it you're on, right at about 44.64. We look at our momentum gauges. There's no bullish or bearish divergence here at this point, so the momentum indicators on the daily are pretty much just reflecting what we're seeing in the price action. Taking a look at the weekly chart, we have this 50-week moving average. And recall, I've been making a big deal out of this pattern right here and pointing, over the last 2 or 3 decades at similar patterns. And so when we break through that 50-week moving average with some momentum, we'll often battle with it for a while. This is a pattern, though, that hasn't looked good historically. And once we break down through there after a retest or 3, you tend to go down and at least test the 200-week moving average, which is, 3,400 on the S&P, which is a good 20+% lower from here. So this is very much within the realm of possibilities right here, folks. And then lastly, with regard to the S&P 500, is our 25-year monthly chart. This is the one that we really should be sitting up and taking notice over. Literally every single time we had a sell signal on the moving average convergence divergence, where the white line drops below the signal line, which is the red line. We had a meaningful double-digit correction or bear market, and with one exception, back here in 1998, we came down and at least tested the 50-month moving average. So from a technical perspective, clients, you really should appreciate our hedging efforts in here, because we do believe that there is some real downside risk, and of course there's fundamental issues that the market's having to battle with right here as well. So let's take a look at bonds for a second. So I mentioned in the morning note, actually in yesterday's log that I copied and pasted to the morning note, that we were going to seriously look at scaling into TLT, which is the longer term 20+ year Treasury bond index ETF, and EMB, which is an ETF that tracks emerging market bonds. Well, we actually did take small positions in both this morning. We ultimately, if we're right on our longer term thesis, we'll have bigger positions there. They actually yield 4.75% on the emerging markets and about 2% on the Treasury one. So we're looking at picking up some nice yield, certainly as these become bigger positions, if they do for us. From a technical perspective, you can see there's nothing inspiring about the monthly chart there. When we look at the 1-year daily chart on TLT, so this is the Treasury Bond Index ETF that we're using. Near term, you do have a very defined falling wedge pattern. However, you don't have those bullish divergences here. You do on the RSI to that point. You are oversold, which is short-term bullish, but this isn't a strong buy signal right here. But we do think there is a macro argument to begin seriously looking at bonds right here. And then the other one I mentioned, though, EMB, which is emerging markets. This one I'm a little more excited about, frankly. Emerging markets, central banks, many of them, Brazil in particular, has raised interest rates like 9 times over the last year. So they have significant room to ease if indeed the IMF is right and the global economy is going to feel some pain. Now, I'm sure people would argue with me till the cows come home about the dollar. And, if the Fed's tightening against central banks, other places loosening, that's going to be bullish for the dollar, and that's negative for emerging market assets. I would agree, however, but what I'm saying is that we've had huge sell-off in emerging market debt. And if indeed the narrative flips, which I think it's going to, and people rush into places like Brazil, for example, that would actually be net bullish for the real, which is actually having quite the positive year, and bearish for the dollar on a relative basis. So I don't really buy the dollar argument. And by the way, the dollar's been very strong, and I've made a case, many times here on the videos, that if you get the dollar right going forward, you're going to get a lot right. And the dollar's been strong against higher inflation, and that's because the world is looking at a central bank in the U.S., that is pushing yield, that's going to be pushing yields up. The bond market has already done that for them, relative to places like, Japan, which is continuing to try to keep the pedal to the metal in terms of easing, and the yen's been a disaster this year. And of course, the euro, which is, more than 50% of the dollar index. So when people start talking about how strong the dollar is, they're talking about the index, and the index is pretty much the pairing of the dollar and the euro, or at least largely. And of course, the euro has been a mess, largely because of the Russia situation and a European central bank that is not as inclined as the Fed to get after inflation right here. But as it relates to what I'm looking at here, as you can see on the daily chart, you have a very bullish, very timely looking setup. You have big bullish divergences down here on the momentum. And you do have, you can almost call this a descending triangle, but you do really have a wedge here because this is a lower low. This is signaling that this might be a good entry point. Again, we're not nearly going into the degree that we ultimately think we will if our thesis is correct. Obviously, we're going to do everything we do very carefully right here. So scaling in there, picking up positions that are way, way down relative to where they've been. As you can see, you can just look at the trend here, that now pay very nice yields. And we have a global macro setup that actually could be bullish for bonds, going forward. So we think it's smart to do this, but it's also smart to go easy. Anyway, folks, I think I took a little longer than I intended to. I'll leave it there for today. Thank you, as always, for watching and listening. Be back soon. Bye-bye.